Hello everyone. Today we're going to talk about liquidity, imbalance, and institutional candles. So first we're going to start with liquidity. So liquidity is when there is consolidation or there is a lot of buyers in the market and sellers, a lot of indecisions, confusion. For example, here, this is liquidity. So the reason why it's liquidity is a lot of people stop losses. I hear a lot of people trying to bet that the market is gonna go up here. You know, a lot of people in here trying to buy up and people trying to sell. A lot of stop loss in here. Okay, so what happens is the banks they know that people like to trade off of support resistance. They see people that like to trade off triple bottoms or double tops or triple tops. That somebody saw a triple top or somebody saw a triple bottom, so okay, I'm gonna sell, I'm gonna buy, and I'm gonna put my stop loss here. Somebody else is put their stop loss somewhere here, maybe enter it in here, stop loss above here. you know a lot of stop losses, and then what happens is it accumulates liquidity, accumulates a lot of money in here, and then what happens, what you see is you see something like this. Okay, a fast move down that come and stop everybody that was buying here. So you can move the market to the other side. This is called institutional candles. So institutional candles, because they happen so fast, they leave imbalance in the market, and that's what we're going to talk about. Every fast price action, that usually behind it is there's big money like the banks or the hedge funds. There's usually imbalance that's left, and that has to be filled out. It can be filled out right away, or it can be filled out later. For example, here, this here is imbalance in the market. See how these candles shoot down so quick within 30 minutes. Look, all the other candles, 30 minutes, 30 minutes. This one is 30 minutes, small, 30 minutes, 30 minutes. And but this one, boom, just it's probably swiping some people that was here still buying, still haven't been stopped out yet. So the reason why it's called imbalance is from this week, or from this week here, this week here, this week, and this week. If there is nothing, there is no other week that comes to fill it. So if there was no imbalance, it will be something like this. Okay, it will be 2 weeks that comes together and close the candle. So there's no imbalance, but because you didn't fill it, there is imbalance here. An example of where there is no imbalance is somewhere like here. Um, Somewhere like here. Let's look at here. See here and here. See how these wicks came and closed this candle? So many examples. Another example is right here. Okay, this wick came here and closed here. And this one came here. It's so small, but it's still closed, and you can see there's no imbalance. Same as here or here. Okay, same as here. No imbalance. Yeah. As you can see, there's no imbalance. There's imbalance in here. That's another area that has imbalance. You know, if the market doesn't fill it right away with the wicks, is usually gonna come and it fills it. You see, it went down, came up, filled some of the imbalance, went up, filled some of the imbalance, and then maybe later it went and filled it completely, which left more imbalance here, which is going to be filled later sometime. That's how the market moves, and that's how the big institution move in the market and manipulate the price. Um, so institutional candles is this one. So these institutional candles is the candles that comes and swipe liquidity or slaps the buyers or sellers in the market. The reason why uh, you can say that this was institutional candle, or this was maybe some like these candles or this candle not institutional candles, because what happened is there was people that was buying and selling here, and what happened? Dropped the price down and then went up. And if you trade, if you want to know how the banks move, you want to trade like them, you have entered here and say, maybe I could have waited for the price to come somewhere in between here with the 61.8 or the 50% of this candle, and enter and see if I can make some money. Stop loss below the low. And as you can see, the market came mitigated and came up, slapped this last area of resistance. And you could have made more targets, which we didn't get over here. Something here, all these imbalances here, you could have targeted, but the market only decided to just come slap this resistance and then boom, shoot down. So you could have made here, you know, uh, 260 pips, just risking 100 pips. It's a 1 to 2. So this is how you know how the banks move in the market. In these terms, is going to help you with institutional trading or trading with the banks. So I hope this video was helpful. And as always, remember, you can do, be, or have whatever you want because you're becoming more than you are. You don't need to have something in order to do something so you can finally be something. You just need to be that person who does the things that person does, and you will continue to experience everything that person has. With that being said, everyone, I'm sending you all new waves of peace, abundance, and creativity. And I hope to see you all in the next video. Thank you.